In this video, we'll be talking about 3 different types of investors. I'll be going into detail with each different type of investor, and this way you guys can figure out what type of investor you are, or if you're new to investing, what type of investor you'd like to be. Now, before we go any further in this video, we'll be kicking this video off with a $100 giveaway. 4 lucky winners, 1 winner each week of $25. And all you have to do for a chance to win is to comment below, as we'll be selecting a random comment for a winner, and then hop on over to my website and subscribe with your email address, as that's how we'll be announcing the winners every single week. Also, if you're new here and seeing me for the first time, my name is Eann, and on this channel I talk about ways to make money, ways to save money, ways to invest your money. I talk about bank accounts and credit cards and everything to do with personal finance. So if you like these videos and you like these types of topics, be sure to give this video a thumbs up. I'll really appreciate it. It helps the channel out a ton. And also consider subscribing to the channel with all the notifications on. And that way you'll never miss the updates of when I post new videos, which is every single day on this channel. Now, when you think about types of investors, most people put them into 2 categories. And this is simply just short-term investors and long-term investors. However, we have 3 main groups for investors, and whatever investment style you're using or you'd like to use, it will definitely fall under one of these 3 investment categories. So let's hop right into the first type of investing, or the first type of investor, and this is the firm foundation theory of investing. Now, this theory reasons that any financial asset like a stock or real estate or even any property has some kind of intrinsic value. So in the case of the stock market, or in the case of a stock, the firm foundation theory type of investing would be a person investing not based on the price of the stock, but based on the asset that the business has, the money that the business is making, and the projected assets or money that the company will make. So if you're always looking at the assets of the companies and how much money they're making, and also trying to project what their assets will be and what their earnings will be, then you are using the firm foundation theory of investing. So the main point here is that if you want to follow the firm foundation theory of investing, you'll need to learn how to properly value a company. And when I say value a company, you're, instead of looking at the stock price or history of the stock price, you'll be looking at all the assets that the company has, all the liabilities that the company has, how much money the company is actually making, how much money it's spending, or how much money it has to spend on, let's say, operating costs. And then you'll also have to look at the other companies that are doing the same thing as this company, and then compare it with these other companies to see if this is actually a really good company to invest in. Now, to successfully pull this off, you need to choose a target industry. So for example, you wouldn't try to value companies in all different industries at once. So you'd have to do like Warren Buffett, who prefers to invest in financial products or insurance products, and you could choose an industry, probably healthcare or finance or something else, and then you start looking at the companies in that specific industry, and you start trying to do valuations on those companies to follow the firm foundation theory of investing. Now, if you'd like to learn a lot about investing and valuing companies and choosing your investments, there are 2 books that you can read that will definitely help you out with this. And the first book is The Intelligent Investor, and I'll leave a link below to this book. And also the second book is The Little Book of Common Sense Investing. And these are both 2 inexpensive books. So if you're really interested in investing and learning, you should definitely make the investment and get these 2 books. And I'll leave links down below to these books as well. Now, the next investment theory is the castle in the air investment theory. And this is when you make an early investment in a stock based on what people in the market are interested in, and then you pull out of that stock before the price crashes. Now, this actually happens a lot, and I'll read you guys what the definition of this theory really says. And it says that the castle in the air theory speculates that an investment is worth a certain price to a buyer because the buyer would expect to sell it to someone else at a higher price. This theory was also named the greater fool theory because it is proposed that there was a sucker born every minute. Now, these suckers existed to buy an investment at a higher price than what was paid. So this is like you looking at the entire stock market right now, and you're looking at all the stocks, and you were anticipating that a lot of people are going to be investing in a particular stock, whichever it may be, and maybe they're already investing in that stock, and so that stock is very hot, and so you jump in, you buy that stock, and the price keeps increasing because it's one of the hottest stocks and everyone is trying to get in. However, instead of holding onto that stock for very long, you simply hold until the price goes up and you make a considerable amount of money on your investment, and then you can happily sell that stock even if it hasn't reached its peak, because someone else will happily buy that stock just because it's very popular or because there's a buzz around that stock. And that way you get out early, you make the money, and the other people that are investing while the stock continues to rise, probably way above what the actual company is worth, will be the ones left holding the bag. And when the stock actually crashes or the price falls, you'll be the one to make money from that stock. So this is like you looking at the entire stock market and you're looking at all the stocks and you are anticipating that a lot of people are going to be investing in a particular stock, or maybe they're already investing in that stock and that stock is very hot, and so you jump in and you buy that stock and the price keeps increasing because it's one of the hottest stocks and everyone is trying to get in. However, instead of holding onto that stock for very long, you will simply hold until the price goes up and you make a considerable amount of returns on your investment, and then you can happily sell that stock even if it hasn't reached its peak, because someone else will happily buy the stock just because it's very popular or because there's a buzz around that stock. And that way you can get out early, you make the money, and the other people that are investing while the stock continues to rise, probably way above what the actual company is worth or what the stock is worth, will be the ones left holding the bag. And when the stock actually crashes or the price falls, you'll be the one that makes the money from that stock. This is why it's called a castle in the air theory. Now, although this theory sounds fun and it sounds like you can make a lot of money, it's a lot harder because very few people win with this style of investing, because stocks are very unpredictable and there is no way to time the market or to time a stock or to time other investors' behaviors. So a stock could be hot right now and you could jump in expecting a lot of people to buy into that stock and you could expect the price to skyrocket, but instead there could be some bad news and that stock could crash immediately after you buy in. So this is somewhat like gambling, but if you can pull this off, then you can definitely make a lot of money with the castle in the air theory. Now, of course, this is not financial advice and I'm just giving you guys 3 different types of investing. And if this is something that you'd like to pursue, then there are also 2 books that can help you with this. And the first book is A Random Walk Down Wall Street. I'll leave a link below to that book. And the second book is going to be The Art of Speculation. And I'll also leave a link below to that book as well. And these are also inexpensive books. So if you really want to get involved in this type of investing, I would recommend that you read these 2 books and any other books that are applicable. Now, finally, the next theory or the next type of investing is kind of like a spin-off from the castle in the air theory. And this is a theory that says a sucker is born every minute. And this type of investing really has nothing to do with the value of a stock or looking at the company. It's just simply speculative investing where you purchase a stock with the mindset that there is a sucker that is going to purchase that stock from you at a higher price. So you're really just buying stocks with the belief that someone else who doesn't know what they're doing, who doesn't know anything about stocks, is going to simply purchase those stocks at a higher price than what you paid for them. And this may sound a bit ridiculous, but this does actually work as well. So again, let's say Tesla stock is hot right now for argument's sake, and the price of Tesla stock just starts to skyrocket, and you know that Tesla stock is overvalued by a lot, but you also know that a sucker is going to be born every minute, so to speak, and so you purchase Tesla stock at a very overvalued price, knowing that in 2 days or 3 days, you'll be able to sell that stock for double what you purchased it for, even though it's not actually worth that much. But you know that someone else who doesn't know what they're doing is going to come along and just buy that stock because of all the hype and the publicity around it. And that is how you make money with this theory. Now, you could also relate this to cryptocurrency right now, because there are some altcoins that are actually not very useful and they're just pump and dump tokens. And so you could be sitting on the sidelines and you could realize that this specific token is going to pump really hard. People are rushing into it. And so you know that it's not really worth anything. There is nothing behind the project. It doesn't really have any value. But because people are rushing into it, you buy into that token, and once the price skyrockets, you make some money and you sell your tokens, and someone else will come along and happily purchase, and that way you make money, and essentially they'll buy in at a very high price and they lose money, but you end up winning. So this is also speculative investing because there's no real way to time the market or say for sure which token or which crypto or which stock is going to blow up and then how long it's going to explode for and when you can safely pull out without losing your money. So this is all speculation investing or speculative investing, and this is very risky, and only a few people that invest this way actually end up making money. Now, the majority of people that invest like this usually lose out, and this is why I prefer index fund investing and ETFs, because it's low risk, steady, and more stable gains, and you don't have to worry about doing a lot of research on individual companies or stocks. So comment below and let me know what type of investor you are. Are you the castle in the air type of investor? Are you the sucker that is born every minute type of investor? Or are you the firm foundation theory type of investor? Comment below and let me know. Also, if you guys are looking for a really good investment app or platform, I have links below where you can get free cash or free stocks just for signing up and depositing money in your investment accounts. So be sure to check all the links down below where you guys can get some free stuff. And if you haven't already done so, be sure to give this video a thumbs up. I'll really appreciate it. It helps the channel out a ton. And also subscribe with all the notifications on. And that way you'll never miss the updates of when I post new videos, which is every single day. Once again, thanks for watching. All the best with investing, and I'll see you guys tomorrow in the next one.